Welcome to the second video in the Business Acumen Toolkit series, Resource Planning. What does resource planning look like in your organization? Just a reminder, these videos are not created to be passively watched and listened to. They are tools to be interacted with. We encourage you and other team members to stop and talk about different stages of resource planning. This series is meant more as a discussion guide as you strengthen your organization's business plan while also learning or teaching others foundational budget development skills and language. The Business Acumen Toolkit series is brought to you by the Alaska Association on Developmental Disabilities with funding from the Alaska Mental Health Trust Authority. Your presenters are myself, Kim Champney,
and Brandon Cullum.
Brandon is the business brain of our team while I share my experience with strategic thinking and organizational development. You'll hear our different perspectives throughout the toolkit.
After watching this video, you will know preliminary budget development steps such as gathering input from stakeholders, developing a budget team, and determining your budget structure. You will also be more familiar with revenue projection development methods, general expense categories, labor cost projection techniques, and the impact of non-billable time and other cost drivers on your projections.
This is a simple outline of the budget development steps we will be talking through in this video. We have chosen to focus on the areas that are first, unique to DD provider organizations, and second, that are the more complex to understand as well as the most impactful if not planned for carefully. We will be talking about setting goals, projecting realistic revenue, understanding the needs of direct support, typically the biggest revenue generator as well as the greatest labor expense, other aspects of labor expense, and lastly, finalizing the organizational budget.
Resource planning happens when a company outlines how much money it expects to earn and how it plans to spend that money to deliver on its mission. You may know this as the budget process. Budgets perform another important role in an organization. They set management expectations by assigning authority for resource spending and responsibility for meeting goals.
Planning for how to use resources to meet the mission, again, must be driven by priorities outlined in the strategic plan. Before we dive into the details, keep these budget best practices in mind. Number 1, your organizational budget should reflect a long-term perspective. For example, is service demand likely to change in future years? Will any facilities or equipment need significant repair or modification in the next few years? Will some savings be used now or in the future? Number 2, your budget should link to broad organizational goals. Because the budget expresses how resources will be allocated and what measures will be used to evaluate progress, budget development is more effective when linked to overall organizational strategy. Linking the two gives all managers and employees a clearer understanding of strategic goals. This understanding, in turn, leads to greater support for goals, better coordination of strategies and operations, and ultimately to stronger performance. Number 3, your organization should focus on measurable outcomes. Use the budget process to document exactly what another year of the organization's existence should accomplish. Number 4, your budget is a communication tool to stakeholders. What priorities does the budget demonstrate to employees, to funders or donors, to customers? Number 5, the budget process should be motivating to employees. A healthy budget process energizes staff, encourages their ideas, and fosters dialogue across the organization about how to make the most progress from the resources available. Stress the value of staff engagement and understanding of the organization's economic engine. It's important to balance with the discussion of mission.
Resource planning starts with the development of a budget team. A budget team comes together in many ways, but most will have program contacts, a budget manager, an information manager, and executive leaders. Each discrete section of your agency should be represented by a program contact. These team members deliver program-specific information, like utilization projections, to the budget team and reflect on how budget decisions might affect a program and its ability to meet goals. The budget manager is responsible for overall budget development. They will set timelines, facilitate the flow of information between parties, and maintain high-level authority for setting budget-related deliverables. This position is often a chief financial officer, a controller, or a high-level accounting position. The information manager is responsible for collecting and organizing the data used in projection processes and in adjusting goals. Examples of data include historical expenses and service projections. Executive leaders are responsible for approving budget requests, overseeing the overall process, reporting to the board of directors, and assuring the budget reflects strategic goals and planning for agency resources. Who are the members of your organization's team?
To be most effective, budget structure should mirror how an agency assigns responsibility to its managers. It should match the org chart. If your managers are responsible for service channels like day habilitation, support services, etc., then it would make sense to structure the budget around service channels. If your managers are responsible for regions, it makes sense to organize the budget around regions. When your budget mirrors areas of responsibility, then it more clearly articulates the goals set for management.
A budget's time frame also impacts a budget's usefulness. The longer the budget period, the longer between points in time that management can compare the budget goals to actual performance. Once a year, quarterly, and monthly are all common time frames. There are multiple ways to slice and dice time frames, but the best approaches take the most time. Annual budgets, which are less labor-intensive than monthly or quarterly budgets, can be divided by 12 to accommodate monthly comparisons to actuals, but this method does not accurately account for monthly and seasonal fluctuations in revenue and expense activity. As a result, actuals will often vary greatly from budget and monthly reporting. A true monthly budget, while more time-consuming, will reflect well-researched patterns for each individual month.
School schedules provide a good illustration of the difference between the two approaches. If an agency projects providing $100,000 for day habilitation, but only builds an annual budget and divides it by 12 to compare monthly actuals, each month will show the same amount of day habilitation revenue and labor expense, while actuals in summer months will likely show greater than budgeted because services increase for children when school is out, and winter months will show far less than budgeted. A manager won't be able to see how close expenses are tracking to budget until close to the end of the fiscal year. On the other hand, a monthly budget prepared by looking at historic actuals for each month, or at least realistic expectations for each month, will provide a much more realistic and detailed estimation. As such, if actuals vary greatly from budget, it is a better indication that actual performance is starting to move away from the plan and a manager needs to act. The shorter the time period a budget covers, the more detailed information it provides. But this is only true if the time period is actually researched rather than arrived at by dividing a budget that covers a longer time period into smaller parts. How does your organization project revenue?
Budgets generally come in two categories, capital and operating. Capital budgets set goals for cash expenditures on capital assets like buildings, vehicles, and personal property like IT equipment and office furniture. An operating budget sets goals for day-to-day operations. An operating budget includes revenue, expenses, and net income sections. Money comes in, it gets spent, and maybe there's some left for later. This module focuses on operating budgets.
The first part of any operating budget is the revenue budget. The money has to come in before anything happens. DD agencies will typically have revenue from billable services, grants, and donations and fundraising. Accurate revenue projection is vital to setting reasonable expense goals, but the process can be tricky. The revenue you actually get, especially billable service revenue, is rarely equal to what at first looks available.
Billable services represent the greatest challenge in revenue budget development, so budget teams should start this process early in the budget development cycle. Getting to a reliable billable service projection requires an honest assessment of what your organization is capable of and how much of a service an individual might actually use. It may be tempting to look at all of the units of service available and all of the plans of care and assume those units will be billed, but reality is often very different, and revenue often much less.
The best indicator of future behavior is often past behavior, so a sound revenue budget will be built on the average amount of services used in the past and then adjusted based on feedback from the individual, direct service professionals, care coordinators, and family members about what life will look like over the budget year. This process requires close coordination between program contacts, who provide information from all the stakeholders, and information managers, who provide historical utilization. By working together, these team members can deliver a reliable estimate of billable service revenue. The more detailed the analysis, the more accurate your revenue prediction will be. This table provides a basic example of an individual by individual, unit by unit analysis, which brings the highest level of accuracy, but it takes a lot of time. A more expedited result can be achieved by calculating an agency's overall utilization rate. Out of all units in all plans, we delivered X percentage of those services, and reducing available units by those rates. This compromise captures historical experience, but leaves out the forward-looking adjustment that the table here illustrates in the notes column.
Once the program contacts and information manager are provided adjusted utilization numbers, the budget manager can simply add all the units of each service and calculate revenue for that service by multiplying those units by the service rate.
Once the numbers are calculated in this manner for each billing source, such as Medicaid, insurance, and private pay, they end up looking something like this in the budget layout.
Grants can be awarded as set amounts, reimbursement for services delivered, or in exchange for satisfying some other mix of requirements. Set awards are the easiest to budget because their contribution to revenue is set in the award. Budgeting for reimbursement style awards looks like budgeting for Medicaid. The budgeting team has to establish how many units of service it can reasonably expect to deliver and base its revenue numbers off of those achievable units. With that, you have an agency-wide revenue budget. The best part is that in building the revenue budget, you've already done a lot of the work you'll need to develop an accurate expense budget.